Hello everyone and welcome back to the sessions on financial reporting. Friends, in this class we are continuing with Ind AS 12, that is income taxes. This is the fourth lecture on income taxes. So in the previous class we have completed discussing all the concepts which were within Ind AS 12. This class is meant for taking up some important practice questions as I have mentioned on the screen as well. So let us just begin with some important questions. Let us begin with question number 12. Let us read this question. X Limited issued 10% debentures of rupees 10 lakhs nominal value at 5% discount, redeemable after 5 years at 10% premium. The company incurred rupees 67,890 towards issue related expenses. In its books, the company adopts Ind AS 23 for recognition of borrowing costs. As per tax law, discount and expenses on issue is to be amortized over the life of the debentures, and the premium on redemption is allowed as deduction only on actual payment basis. The profit before considering borrowing costs were rupees 8 lakhs each year. Tax rate is 30%. You are required to determine annual amount of tax expenses, showing detailed calculations of current tax and deferred tax as per Ind AS 12. Now friends, if you carefully observe this entire situation, what is identified over here? In accounting records, you are following Ind AS 23, which would ask you to apply effective interest rate. So amortization of discount, amortization of expense on issue and amortization of expense towards the premium on redemption all will be considered on effective interest rate basis. In other words, the borrowing cost will be as per effective interest rate, and which will include four components in this case. That will be interest payment, second the expense on issue, discount on issue and premium on redemption. All these components of borrowing cost will be clubbed into one effective interest rate. As a result, as per Ind AS 23, you need to figure out what would be that rate which will accommodate all these factors. But as per tax law, the concept of effective interest rate will not apply, and as mentioned in the question, the interest payment will be allowed as a deduction as and when the interest is paid. Expense on issue and discount on issue will be deductible on systematic amortization basis, where amortization is permissible over the life of the asset, and the premium on redemption will be permissible as a deduction only at the redemption date when the payment is actually made. As a result, the overall outflow will be recognized as expense in accounting records as well as from the viewpoint of taxation, but the timing will be different. As a result, there will be definitely temporary differences that will arise, and that is where we need to apply Ind AS 12 to identify what would be current tax in each year, what would be deferred tax in each year, and what would be tax expenses in each year. So let us see how to present the solution. In your solution, you first begin with the nominal value of debentures issued, that is 10 lakhs. From that you subtract the discount on issue, that is 5% of 10 lakhs, 50,000, and the expense on issue, that is 67,890. When you subtract these, the net proceeds in hand will be 8,82,110. In fact, as per financial records, this will be the liability that will be recognized at the time of issue. Now, we will have to figure out the effective interest rate, and for that we will have to try out certain discounting rate where all the future cash flows would match with the net proceeds. So let us make a trial using a 15% discounting rate. Why I have considered 15% for trial? Because first of all, the interest payment is 10% already. Then there will be more expense because of discount on issue, expense on issue and premium on redemption. As a result, the expense will definitely be more than 10%. So for trial we have taken 15%. So what we find that year 1 to 5 the cash flows will be constant, that will be payment towards the interest, that is 10% of 10 lakhs, and we have applied the annuity factor at 15%, that comes to 3.352155. The present value of this recurring cash flow will be 3,35,216. At the end of 5th year, the total cash outflow will be the redemption of the debenture at premium of 10%, that will be nominal value 10 lakhs plus 10% premium, which would make it to 11 lakhs. That 11 lakhs will be discounted at 15%, where the present value factor comes to 0.497177, and the resulting present value is 5,46,894. Now when you total up the present value of cash flow, fortunately in this case it is matching with the net proceeds. Because the present value of cash flow is matching with the net proceeds using 15% discounting rate, we can clearly identify that it is exactly 15% which can be considered as effective interest rate as per Ind AS 23. And this effective interest rate concept we have covered in detail with Ind AS 23 as well as under Ind AS 109 earlier. Now you know one thing, that if this present value would not have matched with the net proceeds, you would have used IRR concept to determine the exact rate which will be considered as effective interest rate. In this case it is clearly 15% per annum. Now please take care of one thing, as in when I instruct you to write down the solution, you can just pause the video, note down the solution and again resume the video, because I will not be separately giving you additional time to note down the solutions. So please do the needful. Right now let's just look at the solution. So as instructed, just pause the video, write it up and then you can resume the same. Alright friends, you would have finished writing this much. Let us move ahead and continue writing further. As per Ind AS 23, you are first of all going to compute the interest expenses using effective interest rate of 15% on year to year basis, and you have learned how to do it. Year 1, the net proceeds received initially will be the opening balance of liability, and interest expenses on effective basis will be at 15% of this liability. So interest expenses that will be recognized in accounting records will be 1,32,317, which is 15% of 8,82,110. Mind it that the interest that will be paid every year will be just 1 lakh, whereas the interest that will be recognized will be 1,32,317. That is 15% of the opening balance each year. So what will happen, because the payment is less than the amount of expense accrued, you are finding that closing balance of liability will be more than the opening balance. So to find the closing balance, you will take the opening balance, add interest expenses which is accrued and subtract the payment made, and you find out that the closing balance is increased to rupees 9,14,427, which will become the opening balance for second year. Again in the second year you will apply 15% effective interest rate on the opening balance of second year, that is 9,14,427 into 15% would give you interest expenses of 1,37,164, and the payment again is rupees 1 lakh. So closing balance increases to 9,51,591. You keep on making the calculations this way for all the remaining years, and what you will figure out when you come at the end of 5th year, your closing balance of liability would match exactly with the redeemable amount, that is rupees 11 lakhs. And now when you take the total of your interest expenses, in total your interest expenses for 5 years taken together is 7,17,890. So simple point is your initial recognition of liability was 8,82,110. To that, if you add interest expenses of 7,17,890, that will be your overall payment obligation, out of which 5 times you have already paid 1 lakh. So your net liability at the end would be exactly matching with the redeemable value, that is rupees 11 lakhs. So quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up the solution further. Calculation of expenses allowed under tax law. So what we have just done earlier was the expenses that were recognized in the financial records, and now we are talking from the viewpoint of tax law. So please carefully understand this working as well. In the first year, the interest expenses that will be allowed under tax law will be the amount of interest that will be actually paid, that is rupees 1 lakh. The discount expense will be allowed on annual amortization basis, where it is clearly mentioned in the question that the discount on issue will be amortized over the life of the debenture. Because it was 50,000, 1/5 of 50,000, that is 10,000 each year will be allowed under tax law. Similarly, 1/5 of the total issue expense will also be allowed as expense each year under tax law. That works out to 13,578. And no part of redemption premium will be permissible unless it is actually paid. That means it will be allowed as expense only at the end of 5th year. So nothing comes under the redemption premium column. So expenses that will be allowed in the first year will be aggregate of 1 lakh plus 10,000 plus 13,578. That comes to 1,23,578. Similarly, you are going to show calculations for each of the 4 years, and in the 5th year, the additional point that you have to consider is the redemption premium, which will be allowed as expense, and that amount is additional expense of rupees 1 lakh. That added to the other components of expenses, the last year expense allowed will be 2,23,578. Now when you take the total of expenses allowed, it comes to 7,17,890. Now if you could identify, this same amount was the total expense recognized over the span of 5 years under financial records. So it is only the difference in the timing when the expense is recognized in financial records and when the expense is allowed under tax law, and that is why the nature of difference that will arise between the accounting income and taxable income will be basically temporary differences only. So before I take you ahead with the calculations, first quickly take note of what you find on screen right now. Alright friends, you would have finished writing this whole thing. Now when we have got the details of expenses recognized under financial records and expenses allowed under tax law, it is time for us to compare the two and find the differences. So what we do is, we will start with year 1. The expense recognized as per Ind AS 23 will be 1,32,317. How we got this expense you have seen in the earlier working. The expense which is allowed as per tax law is 1,23,578. Now can you notice one thing? The expense allowed under tax law is less and the expense recognized in financial records is more. As a result, the taxable income will be more than the accounting profit, and therefore the nature of difference will be deductible temporary difference, and that works out to 8,739 for the first year. We will obviously take this difference on a cumulative basis, because based on this the deferred tax asset would arise. So 8,739 is the figure for the first year. Similarly, we go for the second year. Expense as per Ind AS 23 will be 1,37,164, and expense allowed as per tax law is again 123,578. we find the same type of difference. So there is increase in the deductible temporary difference by 13,586. So the total cumulative difference would be 22,325. The reason why are we taking cumulative figures is because we are not comparing the liability with the tax base value. I mean the carrying amount of liability with the tax base value. We are instead comparing annual expenses. So we need to figure out the cumulative balances. I will definitely show you the other way of solving this question also. But let us first continue with this approach and just carry on this working exactly the way I have explained you, and you would see each year the deductible temporary difference goes on increasing, and therefore the cumulative balance is also building up. That means every year the balance of deferred tax asset would just go on increasing. Finally, what we do is, when we come to the fifth year, what we identify, expense as per Ind AS 23 that is recognized is 1,56,520. On the other side, the expense that is allowed as per tax law is 2,23,578. Now this time we find that all those difference that were arising each year, now the difference is getting reversed, and the amount of reversal, if we can figure out, it is exactly matching with the cumulative balance of 67,058. So this time, because the difference is getting reversed, we are showing that with a negative sign, and finally the cumulative balance becomes 0. So that would be simply the comparison of expenses as per Ind AS 23 and expenses allowed as per tax law. We know one thing, that aggregate of both of these are same, 7,17,890. So what is identifiable, that the overall amount of the expense being same under Ind AS 23 as well as per tax law, it is only year to year basis that the values are different, and that is why the nature of difference what is arising is temporary difference, and I have also explained you why it is a deductible temporary difference. So quickly take note of this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take the alternative approach, where we will compare the carrying amount of liability with the tax base of such liability. So let us carefully understand this working. First year, the liability as per accounting records, it was 9,14,427. So if you would want to reconcile from where we got this figure, just look at the closing balance of liability as per accounting records that we have made in the earlier workings. If you can look into the working that you have made earlier, you would figure out that it was 9,14,427. That was the carrying amount of liability as per accounting records. On the other side, when you look into the tax base, the amount of debt as per tax base will be simply the nominal value, that is 10 lakhs. Discount on issue initially was 50,000. 1/5 of that discount was amortized. So discount on issue will be 40,000, and similarly 1/5 of the amount of expense on issue was also amortized. So after that amortization, the tax base of expense on issue will be 54,312. Now understand one thing very well. Out of this total amount of debt, when you subtract the discount on issue and expense on issue, that is, all these are representing the tax base of each of these components, what you get is the net tax base, which will be A minus B minus C, that comes to 9,05,688. Now you have to make the calculation in this pattern for each of the 5 years, and you would see each year in the tax base the discount on issue and expense on issue both are reducing, so the tax base amount is gradually building up. On the other side, the liability as per accounts is also rising up year after year. And finally, when you come at the end of 5th year, what you could identify is your balances of liability as per accounts is exactly 11 lakhs, and your balance of tax base is also 11 lakhs, because the amount of debt will be 11 lakhs and discount on issue and expense on issue will not be there at all. As a result, your net amount of tax base at end of 5th year again comes to exactly 11 lakhs. So here we are not comparing the expenses, but we are comparing the amount of liability, that is the carrying amount of liability, we are comparing with the tax base of the liability. So before we go for that comparison, first write up this working quickly. Alright friends, you would have finished writing this calculation as well. Let us move ahead and finally compare the liability as per accounting records and liability as per tax law and find the cumulative deductible temporary difference each year. So simply compare the two amounts. Both of these amounts of liabilities we have reflected in the earlier workings. Now we just have to compute the difference, and we can see that this difference matches with the cumulative difference that we have figured out when we have compared the expense of each year on a cumulative basis. So this is just a simple reflection of the same working but done through a different mode. So you need not write up both the approaches in examination. I would prefer that you should solve the question by this second approach where we are comparing the amounts of liability. But for your better understanding, I have given the viewpoint of expenses also. So once you find the cumulative deductible temporary difference, when you apply tax rate on this, you will be getting the amount of deferred tax assets. However, the calculation of deferred tax, current tax and tax expenses you have been doing all the time. So you know how to do it. So I am not showing those calculations over here in the solution. That is something that you need to do on your own. So just write up these calculations and we will be putting an end to the session after that.